Hello and welcome to the Commercial Real Estate Podcast, episode 132. We've entitled this CRE Optimism. CRE, Commercial Real Estate Optimism. For some reason, almost every article that came out this week has a positive spin on commercial real estate, even in the office sector. So we're going to dig into that. We have a series called Office Sector Woes. But finally, we get to some optimistic commercial real estate news. Is it justified? Should there be optimism? Well, let's take a look. We'll dig into a few of these articles. But before we begin, thank you for tuning in to this weekly look at commercial real estate news and events. If you haven't already subscribed to the Commercial Real Estate Talk channel on YouTube, I invite you to do that. Not only do we put out this weekly look at commercial real estate podcast, which is a longer format podcast, but we also have video shorts that explain terms and tips on commercial real estate under 1 minute. Great way to learn commercial real estate in 1 minute or less. And we are planning to roll out in the near future maybe a 5 or 6 minute teaching blocks on some of these subjects that we discuss in these 1 minute shorts. So please do us a good deed and hit that subscribe or like button and share us with others. There's others that need to know about commercial real estate. All right, we're going to jump right in here. Give me a quick second as we catch our bearings and go into these articles. And you'll see a lot of the articles are really taking a positive spin on what's happening. So is that a hint that we're close or at the bottom? You know, there's some Monday of this week, we had this devastating effect in the stock market. Seems already 3 or 4 days later, it's old news, but everyone was freaking out. Are we in a recession? What's going on with the stock market? Are we seeing the start of a bear run? And here come all these articles. So let's get into them. This is from Globe Street. New York City, or NYC CRE. See, I'm not the only one who uses CRE. New York City commercial real estate set for a golden age of investing. Value of properties could go up by up to 60%. Again, from Globe Street, the commercial real estate market in New York City is set to see a big surge. A major investment firm based in the city is projecting. Well, who's that investment firm? KPG Funds, which sees property values, particularly in the next 12 to 18 months, skyrocketing between 50 to 60% of said the CEO of the company, Greg Krotz. So he is predicting, let me make myself a little smaller here so we can get more of the article in your possession here, 50 to 60% in the next 12 to 18 months increased in property values. Okay, well, you want to get in front of that, right? Now's the time, essentially, that he's saying is the bear bottom. And so get your assets now, because the next 12, 18 months, we could see a turnaround. Well, why would he say that? I haven't dug into the article. My guess is because the economy is doing so poorly, right? Stock market was kind of holding up things, even though that's not an indication of the economy as such. But when the stock market starts to crash, the Fed takes things seriously. They haven't been cutting rates. Now they're going to probably start cutting rates at a faster clip, which is going to increase the value of commercial real estate as the debt comes down due to the lower interest rates. So you've had this compression on cap rates, or expansion, however you want to look at it. Cap rates have been increasing because the debt has been increasing. If the Fed starts cutting rates, you're going to see those cap rates compress one more time, and the values go up. So that, I think that's probably what they're forecasting is the economy is kind of showing signs of recession. So now may be a good time because the Fed's going to start cutting rates. So go out and get your deals now. With the stock market tanking and unemployment rising for the fourth consecutive month, it might be fair to expect multiple rate cuts. There you are, exactly what we talked about, implemented going forward by the Federal Reserve. That will, of course, lower cap rates in the next 12 months. KPG, which invests in the transformation of properties into office spaces in the CRE market, estimates the central bank to reduce rates by 200 basis points in the next year. I don't know why they don't just say 2%. It sounds fancier to say 200 basis points, but let's say rates are 7.5. They expect it in the next year to go down to 5.5, or if it's 8, to go down to 6. 200 basis points, another way of saying 100 basis point equals 1%. Go figure. I don't know why they do that. Well, we're not going to just keep digging in. Let's forward in here. All right. Leasing demand has been up in New York City. In fact, Manhattan saw leasing velocity reach 15.5 million square feet in the first half up 8.9% year over year, according to Savills. That's a good sign. Folks are feeling a little bit better. I think what's happening with some of this leasing volume is the dust is settling on this work from home, on post-pandemic policies, and now corporate America is finally starting to realize this is kind of what we need. And that's what uncertainty is difficult for the business community because they just freeze. Do we need more space? Do we need less space? Can we renew? They've just been kicking the bucket down the road or the ball. Now things are settling down. So now they can start doing longer-term deals, 3, 5, 7, 10-year deals again. Things are settling down, and so leasing activity seems to be trending back towards normal. Of course, the Sun Belt market, which includes southern states like Florida, has been one of the hottest trends in CRE thanks to significant population growth. In an ideal world, companies would be wise to leverage both New York City and areas like Florida, but Kraut thinks that the talent level or level of talent that is coupled with employers put the Big Apple on top, at least for now. Well, some of us down here might disagree with that, but according to Kraut, he thinks there's going to be a surge in Manhattan due to talent. That could be the case. I don't know. A lot of folks have left New York. All right, so this is KPG. If you haven't heard of them, now you do. They're a major New York City investor, and they believe now is a good time to start investing in real estate, and they're making a plug for New York City. Here's another one from BizNow. TPG to unleash $14 billion on buying high-quality assets. $14 billion. Private equity titan TPG is gearing up to purchase top-shelf real estate assets with $14 billion in dry powder across its real estate business, ready to deploy. I'm not sure what BizNow means by dry powder, but in Miami that sometimes means something different than they're probably intending. But in essence, they're raising capital. So KPG, TPG, no relation other than the PGs, I guess. What is this? Here we had KPG, and here is TPG. Hopefully it's not just a typo, and that's not the same group. But it is two different groups, according to different CEOs. They're also raising capital. You know, what's going on? The sharks are out, right? They're seeing this is a good time to buy. Listen, I've always said commercial real estate's here to stay. Why? Because as long as there's commerce, which is the exchange of goods and services, there needs to be a place to conduct those exchanges. Certainly the internet has modified that, and even that in of itself is a place to exchange, but you still need places to put things. You need places to put people. You need bricks and mortar. So commercial real estate's here to stay. It may wiggle at times, whether it's more in flight to quality, Class A, Class B, industrial, retail. The footprint and how it's designed might change, having more open spaces, having more collaborative spaces, having more closed spaces for offices. These things may wiggle around, but in the end of the day, we still need places to conduct commerce. All right, TPG CEO John Winkelried said on Tuesday earnings call that the firm has seen a significant increase in investment activity since mid-2023 and has itself acquired a number of distinctive high-quality assets from sellers in need of liquidity. He anticipates that trend continuing. With combined dry powder of $14 billion across our real estate business, we expect to lean into the growing number of interesting opportunities we are sourcing in core areas of focus. There you are, folks. Those of us who dive into sales, investments, reach out to John Winkelried. He's got $14 billion of dry powder he doesn't know what to do with, all right? TPG invested $1.2 billion in real estate acquisitions in the second quarter, including buying 2 Manhattan office buildings for residential conversion. Very interesting. The private equity firm paid $150 million for 222 Broadway, a joint venture with GFP Real Estate, and more than $100 million for 101 Franklin Street. The office tower at 222 Broadway lost a significant chunk of value since it's traded hands in 2014 when Deutsche Bank's asset management arm DWS acquired the property for $502 million. Wow. Listen, Deutsche Bank, 2014, $502 million they bought that building for. 10 years later, they sold that building for $150 million. That's $372 million of evaporated value. Commercial real estate is not for the faint of heart. It's unbelievable. You know, Deutsche Bank's like, it's a drop in the bucket, and they're not going anywhere. But that's That is massive. And that's what we're seeing even in South Florida. We're seeing that. In fact, we're tracking something in Coral Gables of interest. If you're interested, reach out to us. But we're seeing that too. Properties selling for losses. And boy, that's a huge hit. All right, let's see. The 101 Franklin Street property also took a markdown from $205.5 million to $100 million. All right, Columbia Property Trust and Normandy Real Estate Partners pay for the building in 2019. Oh, my. I'm sure someone had a lot of explaining to do. 2019, they bought a property for $205.5 million, only to sell it 5 years later for $100 million. As my old boss, Alan Morris, used to say, that dog don't hunt. That's not going to work. And listen, that's an indication of what's happening, right? 5-year cycle in commercial real estate led to a 50% devaluation. And, when I got into this business, we used to do 14-year cash flow projections in the 90s. And, of course, developers and owners, the rates just keep going up 3, 4, 5% every year. For 14 years, they never assume a pandemic, never assume oversupply, never presume a dot-com bubble or a recession or a 9/11. I mean, all these have been part of my real estate careers that threw a huge wrinkle into people's projections. But I think there needs to be some form of stress projections in some of these deals to avoid losing 50% value or more in the case of 222 Broadway. So there you have it. Look, no wonder TPG has $14 billion of dry powder. You're getting things at a 50% discount in Manhattan. Of course, I'd be very optimistic. And sure, why not? If you can get something at a 50% haircut, how can you not make those numbers work? You've got a lot of options now. You can convert the property if you want to do a resi conversion, or you can just undercut the market and put lipstick on the pig and lease at lower rates than everybody else, or you can pump tons of dollars and increase the quality of that building. But you see, these guys who bought the building for $500 million, Deutsche Bank, or Columbia Property Trust for $200 million, they were stressed out. They were upside down on liquidity. Their loan-to-value ratios were upside down. And they probably sold just to not avoid giving the keys to the bank. So they couldn't do those conversions. They couldn't spend the money. But those with dry powder cash on the sidelines can. So again, I would agree with these two first articles that we're seeing a pent-up supply of cash building from these folks, these big investment funds, and now's the time to start hunting for these types of deals. So if you can get a good quality asset in a good quality market for Miami, think Brickell, downtown, Coral Gables, Doral. I think Doral, Waterford, Coral Gables, those three markets, you're going to start seeing deals. I think those three. In fact, my understanding is, listen, let's talk about Doral real quick. The former Miami Herald or Southcom building, about 150,000, 160,000 foot two-story bunker. We're talking backup generators, impact-resistant glass, 80,000 square foot floor plates, fully furnished. Office users can come right in, negotiate a bare bones deal, have tons of parking. I understand that project is under contract to be sold to an industrial developer who's going to raise the whole project and build a warehouse. So those are the types of deals that are out there. Who would have thought buying a 150,000 foot office building, knocking it down and building a warehouse with rents at half of what you collect on office? Those are the types of deal that this dry powder that KPG, TPG are looking for. And those are deals that, listen, we'd love to put you in front if you're an investor listening down here in South Florida. All right, let's keep going because there's more optimistic news. Here's another group. IP Capital raises funds for Florida property investment. So first two we talked about, we're really focusing on Manhattan, New York, but even groups from here, this is from CoStar, are looking at South Florida. Investment firm to target distressed, undervalued assets, which, again, very hard to find in South Florida. But here is IP Capital Partners acquired 267,000 foot and change distribution center in Tennessee. IP Capital is gearing up for the next wave of acquisitions with a focus on distressed and undervalued commercial properties after completing the initial closing of IPCP Florida Realty Value Fund 4. The closing yielded $95.4 million in equity to target industrial and office properties in the southeastern United States. With emphasis on Florida, the company said in a statement, Boca Raton-based firm aims to increase the fund size to $125 million over the next 12 months. Now, that doesn't sound like a lot, right? I mean, IP's raising up to $125 million. We just talked about TPG, $14.2 billion. But again, $95 million as part of 30% equity down. You know, you're going to put 70% factor upon that. So let's just call that 500 to 600 million of purchasing power, maybe 700 million of purchasing power. So that's going to buy you a lot of real estate, especially in Florida. Florida has benefited from the population and business growth accelerated by the post-pandemic environment. According to the U.S. Census Bureau, population growth of 2023 of 1.6% from 2022 trailed only South Carolina at 1.7%. There you go. The two fastest growing states are Florida and South Carolina. The state's application for new business license increased 9.4% in 2023 from 2022, second only to California, which grew at 14.5% clip. So maybe the demise of California is a little overrated, though last week we talked about Chevron and others that are just flying out of California, including Tesla. Southeast booming population has raised demand for regional distribution centers and increased global trade, has made space near ports more valuable, said Jason Isaacson, president of IP Capital. All right, so we'll stop there. The fund, the fund is targeting 67% industrial, 33% office. Interesting. I mean, I would focus on retail myself. I would focus on retail because, listen, all these folks moving in here, especially the markets like St. Lucie West, Palm Beach, obviously Miami, but Miami's tapped out. You really can't buy land and develop anymore in core areas. But there's the West Coast, south of Tampa, Orlando, and all the nearby vicinities like Nona and everywhere nearby, Winter Haven. I would focus in on retail because this is where all the people are going. And more people, more housing needed, more retail needed. But IP Capital is going to make it a go at their core business, which is industrial and office. And again, if you can get office at a 50% discount like TPG did for 222 Broadway or 150 South Franklin Street, then yeah, why not? I mean, how can you go wrong there? So again, third article, and I could have just pulled article after article after article on the optimism in commercial real estate due to all these funds starting to raise capital. They're seeing the bottom. This is what this is signaling. This is what I want you to pay attention to. They're saying we are at the bottom. Now, that means how do you execute on that? You better start looking for deals now if you're looking for deals in terms of investments, because you're going to have all this money to compete against. Second, if you're a tenant, now is a good time to talk to your landlord. You want to talk to your landlord while they're under distress and while they're trying to figure things out with their lender about extending your lease. Even if you have 2 or 3 or 4 year leases, if you're large enough, you can go to your lender now, maybe for stretching it. But if you have 2 or 3 years, now is the time to go to your landlord because you've got a listening ear. They're on the opposite end of this. They're not the ones raising the funds. They're the ones dealing with the mess. You want to execute a long-term strategy with them. What you don't want to do is overplay your hand and wait, and then one of these IP Capitals or TPG or KPG or MPG, whoever PGs, comes in, buys your building at a discount, and now they're going to have a longer-term strategy and are able to raise the rates, improve the buildings, and now you're dealing with someone who has a different outlook for your property. You want to deal with your distressed landlord now, of course. Get an SNDA. If you haven't already, if you're 10,000 feet or more, an office tenant, you certainly should have one already, so don't do anything without one. And if you don't know what I'm talking about, go to the Commercial Real Estate Talk channel and subscribe to my shorts. We have a SNDA 1-minute clip, 1 minute of your time. You could learn how this valuable tool can protect you and your business. It's indispensable. But that's what's happening right now. So if you're a tenant, how do you pivot? How do you respond? 1, find out what the debt structure is for your building. We can help you with that at Blue Box Real Estate, blueboxre.com. 2, talk to your landlord. If it's a building you're interested in staying in, downsizing, expanding, talk to them now and see what kind of deal you can cut. You have a lot of leverage right now. All right, let's keep going. CoStar News. Here we go. Another optimistic article. Isn't this wonderful? Look at what the green screen is doing to my water bottle. It's just disappeared because it's the same color. essentially of my green screen. So anyway, I'm not drinking out of thin air. I've actually got a water bottle. You just can't see it. All right, CoStar, world's largest commercial brokerage, raises profit expectations as it prepares for return of deal making. Now, this is CBRE. If you can see up here, we have JLL is coming next. So all the national firms, what a beautiful building here. This actually looks like 2525 Ponce. I wonder if this was developed by Hines, who developed that building. But, and look, look, this is a great trend. Look at how they took this rooftop and put some AstroTurf on it, and it just, it's a lot easier on the eyes to see than just, the algae that usually grows on these rooftops. So CBRE Group tackles higher costs, makes several sizable capital investments in the second quarter. They are the world's largest commercial real estate brokerage. They're raising its earnings expectations for the year as it cuts costs and prepares for deal making to pick up in the coming months. Now, usually the back half of the year, the last quarter, is the most voluminous, if that's a word, deal flow. We have the most deals in September, October, November, December. Some of it is natural. Folks want to close out deals before the end of the year. But that is the highest deal volume that we normally see is that last quarter, which would be October, November, December. And so they're raising their earnings expectations. I guess no one's talking about the election. It seems like we're just flying right through. I guess this is a very rare election, right? Because if it's President Kamala, I'm not sure how you pronounce it, it's more of the same, right? She's part of the Biden administration. The market likes stability. It's more of the same. At the same time, if it's President Trump, it's more of the same as well because we've had him for 4 years. We already know what to expect. So I think the business community, I think the stock market is reflecting that this is a rare election. It's not like we're going to pivot and go in a direction that nobody knows where we're going. Either party, Republican or Democrat, one is there, one's been there, and in terms of the candidate. So I think that stability of the markets knowing what to expect from either party is one of the reasons why you're seeing this optimism, one of the reasons why you're seeing folks saying, okay, we're not going to do the usual pause before the election. We kind of going to keep steamrolling and take advantage of this market. All right, so CBRE expects things to pick up even in an election year. I would agree with them. The Dallas-based firm said its second quarter profit of $130 million was better than it anticipated, though it was still down 35.5% from a year earlier. I mean, that's putting a positive spin. We were down 35% year over year, but that's a lot better than what we were expecting it to be. I mean, I'm going to use that line on agency listings from now on. Hey, you're under your budget, yeah, but we're under not as far as we thought we would be. Revenue, profitability, and cash flow exceeded our expectations with outperformances across all three business segments, said the CEO and chair, Bob Sulentic. All right. The firm's new outlook for the year for core earnings per share is a range of $4.70 to $4.90, an increase from the previous $4.25 to $4.65. Its stock is up about 10% late Thursday. I don't know. I've been looking at the stocks of JLL and CBRE, and to me, they haven't really tanked. I'm waiting. I'm waiting for them to kind of really hit bottom before I consider them. But getting $4.70 to $4.90 earnings per share is not bad. CBRE is the first commercial real estate service firm to report its second quarter earnings, offering a glimpse at the industry headwinds that other commercial brokerages could face. Next week, Cushman & Wakefield, Colliers International, and Newmark are expected, with JLL scheduled for the following week. Salentis said CBRE made sizable capital investments during the quarter, including buying DirectLine Global, a data center management company, and achieved quick material progress on cost challenges we identified last quarter. Look, there is a nice picture of the gentleman here. Leasing and sales revenue grew 5% from the prior year. Office leasing globally increased by double digits, with overall leasing revenue up 9%, bolstered by a 12% growth from the Americas. The United States led leasing activity with 13% increase, buoyed by New York's office leasing rebound. The firm said that leasing momentum has continued into July. So it says New York is the bellwether for the U.S. office leasing activities. I agree, but also San Francisco and Austin have upticked leasing, largely driven around the growth of artificial intelligence. How about that? Artificial intelligence. We have another article from Starwoods that talks about artificial intelligence. So look, there's a lot more to these articles. It's a good reminder that please, if you haven't already, subscribe. Go to blueboxre.com. Subscribe. We're not going to hit you with a lot of marketing or sales. We're going to send you every Monday morning at 9 a.m. a little email with all these articles summarized so you don't miss anything. You have this podcast. If you haven't followed us on LinkedIn, through Blue Box Real Estate corporate LinkedIn page is how you'll see these articles. I also encourage you to go to Commercial Real Estate Talk channel on LinkedIn and subscribe there. And there we're putting all our YouTube videos and everything we're doing, the original content there. So 2 ways that you can touch bases with us. But look, there's a lot more to this article. There's a lot of this article. This is a wordy article. Let's go to JLL. JLL, this is from Biz Now. Their revenue and office leasing jumped by double digits. How about that? JLL ended its second quarter with a 12% spike in revenue compared to last year's figure, led by a pickup in deals and strong returns in workplace and project management. Revenue grew by 19% for the brokerage workplace management arm, 13% for project management in the second quarter. All told, JLL brought in $5.6 billion across its service lines. This is a Chicago-based brokerage, so Seabury, Dallas, JLL Chicago. Its revenues grew year over year in capital markets and property management. Now, let's see here. It looks like JLL actually grew revenues while CBRE lost 35%. Put a positive spin on it because it wasn't as bad. It looks like JLL's revenues actually went up 12%. So they're in positive territory. Global office leasing volume improved 10% year over year. And office leasing activity went up 19% due to improving economic conditions and the stabilization of hybrid work. That's what we talked about. Folks are now pivoting because now they have their strategy. We came out. This is where we are. We are going to be a firm that allows employees to work in the office 2 or 3 days a week, work from home 2 or 3 days a week. That's settled. Now, based on that, we can go out and determine our real estate strategy. That's what's happening. Folks are finally agreeing on what they're going to agree to, and now they can make some movements. And that's what we need in commercial real estate. These brokerage firms, they need movements. They need folks going up, going down. What we don't want is stagnation. And it looks like the volume of large office deals, the article says, being signed is still well below pre-pandemic levels. And new groundbreakings have fallen to its lowest level in the U.S. and Europe on record. Supply is expected to shrink 2025. All right, so that's good from one sense. It's bad from another. It's good for current owners because supply side is diminishing. It's going to be bad for tenants because supply side is diminishing. Supply and demand, less supply, higher rental rates. So again, I can't caution enough. If you're a tenant listening or watching, please reach out to us at blueboxre.com. If you're anywhere in Florida, we can help you across multiple sectors because now's the time you want to start engaging your landlord. You do not want to wait. This is a historically, look, except for if you're on Brickell. I don't know what to tell you. If you're on Brickell, we'll help you relocate out of Brickell into a softer landing market like Coral Gables, maybe the Grove, or go north into Wynwood. But if you're on Brickell, the price of Class A space is going to be $140 to $200 a foot, and there's no new supply, and that's what's going to be. But listen, you can go to Coral Gables, Class A, and get $55 rates all day and be just as happy in Coral Gables and maybe even closer to home. And if you live in Brickell and you go to Coral Gables, that commute is you're going against traffic. It's nothing, both to and from work. So think Coral Gables. A lot of value in Coral Gables if you're a Brickell tenant looking for rent relief. But now is the time you need to start executing your plan, get a good tenant rep broker. Again, I keep pitching ourselves. It's my show. But get a good quality tenant rep broker and start engaging your landlord. We don't need to keep going through this article. Starwood says, Barry Sternlicht, who relocated his offices to Miami Beach, I believe, he said that commercial real estate will benefit when the AI bubble bursts. That's kind of a unique twist there. Not sure what he means there, but he thinks investors' love affair with artificial intelligence is about to end, and a breakup in commercial real estate will be the shoulder that they cry on. Federal infrastructure spending and hype around artificial intelligence has artificially inflated associated sectors like chip makers and data centers. The outspoken executive said in an earnings call for his Star Wars Property Trust REIT's earnings call Tuesday. Sternlicht, who's been calling the Federal Reserve to cut rates for months, expressed optimism that the recent weak jobs report that spurred a stock sell-off would finally push Chairman Jerome Powell to make rate cuts when the Fed meets next months. This is the emperor has no clothes. Sternlicht said, you've seen that the economy is super narrow. The GDP is driven by data centers and spending on stuff that the average person doesn't feel. They don't feel like the economy is working for them. Now, let's just see if I can sift through here. Let's see if I can see. You're seeing it says you are definitely seeing a trend with more capital starting to be returned, which means they have the ability to refinance assets away from us, and that is good. Part of the unfreezing of the markets. Starwood reported adjusted debt to equity ratio at its lowest level in 2 years. Okay, that's good. And said that $1.2 billion of cash and undrawn credit capacity at the end of the quarter. Investors have providing nearly $2 billion in fresh equity to the firm. So here we go. Starwood, another group that has a ton of cash, ready to start investing. I'm not sure the article I'm looking. It really doesn't explain this headline how the AI bubble burst will help commercial real estate. But there's another positive spin, another investor who is looking to invest in commercial real estate, Starwood. So listen, investors, this is who you have to compete with. IPG, KPG, Starwood, IP Capital. The big boys are starting to stock up cash and are ready to hunt for commercial real estate. Now, not everything is rosy, peachy keen. Here we'll make this our last article, $2.5 billion Times Square project taken over by Goldman Sachs led lender group. And this is the downside of what we're seeing. Now, this has to happen, right? I mean, we have to hit some of these crashes. It goes through, and now we'll be able to come out the other side. But one of the most ambitious commercial real estate developments in recent New York history has been taken over by its lender. A Goldman Sachs-led group of investors has taken over TSX Broadway, $2.5 billion mixed-use development from L&H Holding and Fortress Investment Group, citing unnamed sources. Listen, Fortress Investment Group has been very active going after folks. There's a very, very famous case also brewing with Fortress going after Cohen Brothers. I think it is Cohen Brothers. We're going after Cohen and their real estate. I'm sure the article is going to make a comment of that. All right, this takeover comes after L&L and Fortress failed to pay off more than $1 billion in loans for their maturity date. Property will be managed by SL Green Realty following the ownership change, potentially in preparation for sale. L&H Holding and SL Green declined to comment to BizNow. Fortress Investment Group and Goldman Sachs didn't immediately respond to the request for comment. TSX Broadway at 1568 Broadway cost more than $2.5 billion to build, spans 550,000 square feet, including 669-room Tempo by Hilton Hotel outdoor stage that overlooks Times Square, food and beverage terraces, and 100,000 square feet of retail and entertainment space. So it looks like I can't tell whether Fortress and L&H are the ones who lost the building to Goldman Sachs. That's what it looks like. So it's not that Fortress defaulted on this. It's that they were the ones who lost this. So not everything is peachy keen, and these deals are going to continue happening. But this is why you see the billions of dollars adding up, because this is probably going to go to auction, right? It's going to go to sale. And they're going to get this for a lot less than $2.5 billion. So we'll track this. $2.5 billion project, the lender forecloses, and I'll be surprised if this thing sells for $1.5 billion or less. And that's why folks are drumming up the capital raises and saying, this is a brand new project in Times Square, in Manhattan, and we could own it for 50 cents on the dollar. So one man's loss is another man's treasure is going to be true in this cycle. Well, we can go on, and there's more and more articles coming down the road. But this has been a week that I just felt or witnessed a lot of positivity, a lot of, hey, we're getting ready. We're getting ready. The turn is coming. The turn is coming. Things have bottomed. There's a lot of these types of deals like this Times Square project going to go through the system. But there's going to be players on the other side of this, and now's the time to take advantage of your deal. So if you're an investor, now's the time to be hunting. If you're a tenant, talk to your landlord. If you're a landlord, obviously talk to your tenants and let them know. If you're a landlord, let them know, hey, we are in good financial situation. We're here for the long haul. Let's put this together, okay? Look there. See, UBS sells. Here's another one I just happened to see and click. UBS sells New York City office tower. Online auction, 97.5% loss. So I said that was the last article. I apologize. But listen here. They bought a building in 2006 for 300, and I'm going to highlight this, 332 million. All right? The bidder just bought it for $8.5 million. Try to put your arms around that. Here's the building. 135 West 50th Street. I mean, this looks like a very nice building, or this one, whichever it is. In 2006, 332 million. They just bought the building for $8.5 million. I mean, IP Capital, KPG, and MPG, whoever, you guys lost out on one, and maybe Blue Box, who knows? But probably we could have drummed up a bunch of our clients, investors, to buy this. Are you going to see these 97.5% haircuts? Probably not. Look, the building was built in the 60s. It's now just 35% occupied, and it was probably bought to tear it down, right? They're probably going to buy out the rest of the leases, tear it down, build something beautiful there. It's probably sold for land value. But again, these are the types of deals that the market is preparing for. This is the type of deals why you see all this cash building up in commercial real estate, because those deals come once every 20, 30 years. And we're in one of those types of cycles. So if you have patient money, if you have money that you can put anywhere across the U.S., there are going to be deals to be had. And certainly if we can help you with that, we will. So thanks for tuning in. Remember, Proverbs 20:18, plans are established by counsel, by wise counsel, wage war. If you like this podcast, give us a thumbs up, leave us a comment. If there's something you want us to address, talk about, you want to explore any of these articles or anything that we talked about, PM us, send us a note. We're easy to find, and we're happy to come over, have cafecito, get on a call, team meeting, Zoom, whatever works best for you. We're here. Until we talk again, have a great day. God bless. Good day. I'm going to sign off here. Good day.